Hello, my name is František Bostel and I'm the chairman of the board of Startipo Invest, alternative investment fund based in Prague, Czech Republic. Over the past several months, we have built a significant ownership position in Xerox Holdings Corporation. Today, we beneficially own more than 5% of the company, making us fourth largest shareholder. Xerox is high conviction investment for us and one of the largest position in our portfolio. In our view, the market sees Xerox as a declining legacy print company. But reality, we believe, is very different. In the following minutes, we will walk you through our investment thesis. We explain why we believe Xerox may represent a compelling long-term opportunity.
Xerox is an iconic technology company with more than a century of history. But today, the market values the entire company at only a few $100 million. We believe this disconnect creates a rare opportunity. Xerox today operates across two core segments: traditional print and managed print services, and a growing IT and digital services platform. Following the acquisitions of IT Savvy and Lexmark, Xerox now serves more than 200,000 clients globally. Over the last several years, Xerox faced multiple challenges: declining print volumes, integration complexity, and a heavily leveraged balance sheet. These pressures drove the stock sharply lower. But after Q1 2026, we believe the first signs of stabilization are beginning to emerge. Our investment thesis is built around four key pillars. First, stabilize the top line. Second, expand margins. Third, delever the balance sheet. And fourth, unlock shareholder value. We believe these four phases together may fundamentally reshape investor perception of Xerox. One of the biggest misconceptions around Xerox is the belief that print is disappearing. In reality, print is declining slowly, not collapsing. Healthcare, government, financial services, logistics, and education still rely heavily on printed workflows every single day. Print remains deeply embedded inside regulated enterprise environments. Declining industries tend to consolidate. That's exactly what we've seen across the print industry over the last decade. Scale matters. Larger players can absorb fixed costs, improve procurement, and strengthen pricing discipline. The Lexmark acquisition positions Xerox as one of the consolidators, not the company being consolidated. Following the Lexmark transaction, Xerox became a top-tier global player across nearly every print category. The company is now number one globally in managed print services. Importantly, Lexmark also expands Xerox into APAC markets, where the company previously had almost no presence. Revenue declined significantly after COVID due to structural changes in office printing, but we believe the business is now transitioning from decline toward stabilization. The future Xerox will likely look different, less dependent on legacy print and increasingly driven by IT services, workflow automation, and digital infrastructure. Margin expansion is one of the most important parts of the story. Xerox expects more than $300 million of run rate synergies from the Lexmark integration. These synergies come from procurement, manufacturing, overhead reduction, and operational consolidation. In our view, the market still underestimates the magnitude of this opportunity. We do not view Xerox as a pure AI company, but we believe Xerox holds something increasingly valuable: enterprise document infrastructure and trusted workflow data. As AI adoption expands inside enterprises, trust, compliance, and document security may become critical differentiators. The balance sheet is clearly the market's biggest concern. Xerox currently operates with elevated leverage following the Lexmark acquisition. But importantly, the company still has time. Major maturities do not arrive until 2028 and beyond. We believe Xerox has multiple tools available to reduce leverage over the next several years. Q1 2026 was an important proof point. Despite negative free cash flow during the quarter, Xerox secured additional liquidity through the TPG joint venture. The company also began repurchasing debt at substantial discounts in the secondary market. In our view, discounted debt buybacks may become a major driver of future equity value creation. The warrant structure introduced by Xerox is highly unusual and potentially very powerful. It creates an incentive for bondholders to exchange debt for equity. In practice, this may allow Xerox to retire debt significantly below face value without using meaningful cash. Our core thesis is relatively simple. If Xerox stabilizes revenue, expands margins, and reduces leverage, then equity value may increase substantially. We believe the market is currently valuing Xerox under an overly pessimistic scenario. Even moderate operational improvement could materially change the company's valuation profile. We believe Xerox may be approaching an important inflection point. Q1 2026 delivered the first concrete signs of operational improvement. Management reaffirmed guidance. Margins improved. Debt was repurchased at discounts. Startipo Invest has built a high-conviction ownership position in Xerox. We intend to remain a constructive, long-term shareholder. Our goal is simple: support investor understanding of the opportunity, engage thoughtfully, and help broaden awareness of the Xerox investment case globally.
Thank you for watching. Additional materials are available on our website startipo.com/Xerox.